What is your year in review?
Happy New Year. This is Ernie Goss at Creighton University. We're going to discuss our survey for the month of December, but I want to talk about how we ended 2025 and what I think about the beginning of 2026. First off, the themes for 2025. GDP was much stronger than the labor market. Now that's a bit baffling for economists out there. In other words, the GDP growth for the third quarter of 2025 was 4.3%. That's way out there. That's very high. The labor market probably gained very few jobs, so that's what we're seeing. Saw it in manufacturing. Of course, we're going to talk about later on the manufacturing survey that we conducted for the month of December here at Creighton University. But anyway, 2025 was ended with GDP pretty strong, labor market pretty darn weak. Not hiring, but not firing. In other words, a lot of folks will attribute this to AI. No. AI is not having that much of an impact on the labor market right now. It will have, but not right now. What we're seeing is the companies are just holding on to individuals, workers, and not firing, not laying off, but not hiring either. College graduates, unemployment rate is almost three times what the unemployment rate is for the overall unemployment rate. We're talking about a K-shaped economy, continued. In other words, if you think about the K, that's a capital K, not a script K. The upper end, the slope up there, that's those who are doing well continue to do well, driven by asset prices, stock market prices, bond markets, investments, housing, and so on, assets. And then the bottom half not doing very well. I shouldn't say half, it's 80%. I'll call it the 80-20. The 20% doing pretty well, that's the upper part of the K-shaped economy. The 80%, the down part, not so well. We're talking about small firms versus large firms. Small firms are taking it on the chin right now with tariffs having much more of an impact on small firms than large firms. We're seeing that continuing for manufacturing as well. Tariffs elevated in importance. They're all of a sudden mattering. So that's what we're going to see. And everybody who said, well, tariffs don't matter, they do matter. They are mattering. They will matter even more in the first half of 2026. Rural versus urban. Urban doing better than rural. Rural, which of course is in this part of the country dominated by agriculture, not doing well, moving a bit stronger, but still got miles to go before we sleep. Now, what about the next 6 months? We're talking about the economy still, I won't call it jobless. There are some jobs, but not enough. We're talking about moving slightly up to sideways, manufacturing likewise. The second 6 months, I think we're going to see a rebound. Now, this is all circumspect depending on what happens going forward. Well, that's how I saw 2025, and what I'm envisioning for 2026. I'll talk more about details of that at the end of this podcast. So that's how 2025 stacked up and 26 going forward.
According to supply managers in the 9 Mid-America states, how is the economy performing?
The manufacturing, this is a survey of supply managers in manufacturing, stretches from North Dakota and Minnesota in the north to Oklahoma and Arkansas in the south. The overall index for December, not good. December is 47.6. That's down from November's 49.5. It's the lowest reading for 2025, so we're ending on a down note. But again, a lot of activity is stronger than the hiring. Hiring was down. We'll talk about that momentarily. Imports, not good. Reading was 41.6, but that's up from 37.2. So imports were not as negative as they were. Export reading 47.0, that's up from 42.7. Still not above growth neutral, we need to see more exports. The manufacturing sector, exports are just not where we'd like to see. 25% of the survey participants said that tariffs were pushing up prices more than 15%. 37.5% do not support the Trump tariffs. So what we're seeing is increasing resistance to the tariffs of the Trump administration. Here I'll bring up the chart of the U.S. PMI, Purchasing Management Index, compared to the Creighton in beautiful Creighton blue there. And as you see, it's trimmed down significantly from last year at this time. And you see there in red, and I've posted in what I expect the U.S. number to be later on this morning when it comes out. 41.6 is what I expect. And then you see there in the black, that's the rural areas, 50.1. That's the first time we've seen some promising numbers in quite a while for the rural economy. So that's it in graphically speaking.
What were the hiring trends?
Hiring, I don't mean to laugh, it's certainly not funny. And the December number was 44.0. That's down from 47.6 in November. It's the ninth, say that again, ninth straight month below growth neutral. We ask about what do you expect in terms of wages, the average wage expected when they come up for evaluation, 3% going forward, so a 3% pay raise. Now, if you look at inflation, which we're going to talk about shortly, that's about the same. In other words, net, you're talking about no raise. And that's the bottom part of that K-shaped economy.
What inflation trends are you noticing?
The price gauge was unchanged from November's 59.8, still above growth neutral, but inflation definitely has trimmed down, but not enough. Get this, the Federal Reserve's target is 2%. They have not hit the target in 6 years. Now, if I were a hunter and I didn't hit a target in 6 years, I might change my target or quit hunting. Well, they're going to probably change their target. They're not going to quit hunting. The Fed's going to continue to try to hit 2%. They're not going to hit it in 2026, in my judgment. It's the lowest inflation reading since December of 24, or before the tariffs began. And again, the number remains above the Fed's target.
What is the economic outlook?
I expect a rate cut. Now I'm going out on a limb here when the Fed once again meets on 28th and 29th of January. Now that could be changed. That will be changed depending on what happens between now and say the 20th of January. In other words, we've got an inflation reading that's coming out. We have an employment reading that's coming out. I expect the employment reading to be weak. I expect the inflation reading to be a bit stronger than they would like to see. So that would indicate a rate cut. Now, if they're stronger than that, then we'll see no change. Keep an eye on the Federal Reserve's balance sheet. Now, this is very, very, very important. The last meeting of the Federal Reserve Open Market Committee, Jay Powell said, hey, we stand ready to back all. What I mean by that is if we see real troubles here, they're going to bail out. We're in, since 2008, and I'll call it bailout nation. What that means is higher inflationary pressures. So keep an eye on that. In other words, they've abandoned the 2% inflation target for right now, maybe forever. 6 years they've not hit it since. It's been 6 years since they hit the target. The CPI month over month is still going to be too strong. You annualize that, it's still above the Fed's target. Keep an eye on the bond market. The bond market's where the action is. The public out there and the president and the administration keep an eye on the stock market. No, the action's in the bond market and also in the precious metals. That would be silver and gold and other non-precious metals such as copper. Those have been trending higher, significantly higher. So keep an eye on that. That's just indicating more inflationary pressures than we'd like to see, we economists would like to see, and the Federal Reserve. Keep an eye on the bond market. Yields are going to come down on the short end, going up on the long end, which means mortgage rates are going to be moving a bit higher, although they'll be sideways to a bit higher. So keep an eye on that bond market and the balance sheet of the Federal Reserve. The national ISM, as I said, comes out later on this morning. If it's much higher, which I don't expect, if it's like I expect, which is weaker, then that's going to put pressure on the Fed to reduce interest rates. Listen carefully to statements by members of the Open Market Committee, particularly the governors. Now, the presidents of the Federal Reserve banks, they also speak up, but they're mean less, since many of them do not vote on interest rate decisions. We got a 7-5 breakdown, 7 governors, 5 voting members of the Federal Reserve banks. That's how it breaks down. And of course, there are 12 Federal Reserve banks. Only 5 members vote each time they rotate in and out. Price of a barrel of oil, if that keeps moving lower, if that does, it moves between 50 and 60, that's just indicating that the economy, global economy, remains weaker than we'd like to see. Junk bond yields, keep an eye on those. The gap between the yield on the junk bond and the 10-year Treasury, the risk-free, that gap is too small. It's about 2.5%. It needs to be much wider. There's too much, investors are taking too many risks by buying the junk bond, bringing the yield down closer to the 10-year Treasury. It needs to be wider. That we need to see that. The jobs report, of course, that's going to be important, although we've come to somewhat ignore it because there's so many problems with the numbers. They're just not, they get revised to the heck. Well, that's heck, the old Georgia term that we use. I grew up in Georgia many years ago, of course, as you probably can tell. And then keep an eye on the price of gold. Gold and silver. Particularly, I would say silver is even better than gold to keep an eye on. Silver is marching higher because it's being used in industrial products, whether that be batteries, whether that in terms of data centers, whether that's EVs, electric vehicles there. So that's keep an eye on price of silver. It's probably going to be moving higher. It took a fit just this, well, let's see, that would be, this week. The Chicago Board of Trade increased the margin requirements. I mean, come on, guys. It took a hit, and I have to, admittedly, I sold part of my silver that I hold. I should not have. It's rebounding. It rebounded the next day. So anyway, price of silver and gold, and that's it. That's a lot of stuff, economic stuff, to put into one video. And I'd like to say to end this, we're beginning the year, of course. I'd like to thank the folks at Herdot, and Kristen Crawford for all she does in terms of the videos. She's the one that, if you want to blame somebody, blame her, not me. No, actually, if you want to blame anybody, it's always me. I'm the one who screws up, not Kristen. She does a great job. So thanks to her, and thanks for all she's done in this past year, and thanks for what we're going to be doing in the next year. So until we meet again on the first business day of February, may your economic cup runneth over. This is Ernie Goss at Creighton University, wishing you a happy new year.